Would you like to invest in a company that essentially operates as a monopoly? Would you like to be exposed to one of the fastest growing areas of the entire country? Want to collect market smashing passive dividend income? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. It helps us to get the word out and grow the channel. I'd really appreciate it. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is providing its customers with electricity. Electricity is something that we really can't live without. If my power goes out for even an hour, I'm freaking out. Without electricity, our society cannot function. This company profits from that innate need, and so do its shareholders. I personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of PINNACLE West Capital Corporation, which appear to be trading at a significant discount today. PINNACLE West Capital Corporation, stock ticker PNW, is a utility holding company that principally serves as the parent of Arizona Public Service, Arizona's largest and longest serving electric utility. With corporate roots dating back to over 125 years ago, PINNACLE West is now an $8 billion by market cap company that serves 1.2 million customers. The company's one reportable segment is the regulated electricity segment, which consists of traditional regulated retail and wholesale electricity businesses engaged in electricity generation, transmission, and distribution. Residential customers accounted for 51% of fiscal year 2019 electric revenue, while industrial and commercial customers accounted for 44%. Other revenue occurred through wholesale, transmission for others, and miscellaneous customers. APS is vertically integrated and provides retail or wholesale electric service to almost the entire state of Arizona, excepting the Metro Tucson area and about half of the Metro Phoenix area. Fuel sources for APS for 2019 were as follows: nuclear 31%, gas and oil 26%, coal 23%, conventional purchase power 13%, and renewables 7%. Roughly half of the company's energy mix comes from clean resource. Furthermore, they recently announced a plan to deliver 100% clean, carbon-free electricity by 2050. I'm going to tell you a truth. This truth is that our modern-day society cannot function without electricity. It's immutable, it's also investable. Not only is it investable, it's profitable. Quality U.S. electric utilities tend to grow their profit like clockwork. They provide a necessary service to a captive customer base, and they do this in a monopolistic way, as one utility company tends to serve one area. That growing profit translates to plenty of growing dividends, as PINNACLE West has proven out. The company has increased its dividend for 8 consecutive years, with a 5-year dividend growth rate of 5.4%. That growth comes on top of the stock's yield of 4.4%. This yield is more than twice as high as the broader market's yield. It's also 110 basis points higher than the stock's own 5-year average yield. And with a payout ratio of 58.9%, the dividend is secure. Looking at business growth, the company grew its revenue from $3.264 billion in fiscal year 2010 to $3.471 billion in fiscal year 2019. That's a compound annual growth rate of 0.69%. Meanwhile, earnings per share advanced from $3.27 to $4.77 over this period, which is a compound annual growth rate of 4.28%. A modest margin expansion helped to propel excess bottom line growth. These aren't jaw-dropping numbers. Utilities don't wow you with growth. Instead, they just plod along, slow and steady. And that's sometimes just what you want from an investment, especially when you're relying on it for growing dividends. Notably, PINNACLE West, unlike some other utilities out there, has not issued a lot of new shares over the last decade. I see that lack of dilution as prudent capital management. Looking forward, CFRA is forecasting a compound annual growth rate of 4% for PINNACLE West's earnings per share over the next 3 years. This is basically an assumption of the status quo continuing. I think that makes sense, although I'd argue it might be conservative. There's an indication that the utility will see an acceleration in growth. One big advantage for PINNACLE West is the very service area in which they operate. Arizona is the 3rd fastest growing state according to the U.S. Census Bureau. The Phoenix metro area is routinely cited as one of the fastest growing metro areas in the entire country. I'd like to point to the specific note by CFRA, and I quote, "According to the Phoenix Business Journal, Taylor Morrison Home Corp, a Scottsdale home builder, had its best month ever despite the pandemic. The company finished finished June 2020 with a 94% increase in net sales year over year and had an all-time high monthly pace of average sales per community. Further demonstrating the strength of Pinnacle West market, the Phoenix Business Journal reported 9% year-over-year gains in home price growth during Q2, representing the highest growth among 19 U.S. cities measured by the Case-Shiller Index, unquote. This bodes well for Pinnacle West. A mid-single-digit earnings per share growth rate should translate to a similar dividend growth rate. I think the 5-year dividend growth rate is a reasonable expectation for future dividend growth, and that should make investors very happy when considering the stock's elevated starting yield. Moving over to the balance sheet, the company maintains a fairly standard financial position for a utility. The long-term debt-to-equity ratio is 0.89, while the interest coverage ratio is a bit under 4. Profitability is strong, margins are impressive. Over the last 5 years, the firm has averaged annual net margin of 13.64% and annual return on equity of 9.85%. One of the great things about electric utilities is they haven't been affected by the pandemic. Usage might have become more decentralized, but nobody's going without electricity all of a sudden. Moreover, U.S. electric utilities benefit from monopolistic characteristics, which is a competitive advantage. There's typically only one electric provider in any one service area, and a unique regulatory structure practically guarantees profit. In addition, the company has scale. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. While an electric utility doesn't necessarily have competition in the traditional sense, there is the risk of its customers becoming competitors in the future. Advancements in technology could allow for wide-scale renewable power generation to occur at the point of usage. Regulation offers both risk and reward for electric utilities. Local governments heavily regulate utilities and cap their growth. In exchange, utilities are allowed to run local monopolies that have built-in profit, which scales up with operational costs. There's also geographic risk here. Utilities don't have the ability to expand their coverage areas very much, so they largely rely on the underlying growth of those areas. Fortunately, Pinnacle West is in one of the highest growing areas of the United States. I also see pricing risk. The company purchases some of their power. This leaves them vulnerable to swings in natural gas prices. Lastly, there's nuclear risk. Pinnacle West has an interest in the Palo Verde nuclear plant, the largest nuclear plant in the United States. Overall, I see this as one of the higher quality electric utilities out there. At the right valuation, this could make for a great long-term investment for both income and growth. With the stock down 33% from its 52-week high, the valuation now appears to be compelling. The stock's price-to-earnings ratio is sitting at 13.3 here. That's well below where the broader market is at. It's also way off of the stock's own 5-year average price-to-earnings ratio of 19.3. There's also the cash flow multiple. The current price-to-cash flow ratio of 8.2 is slightly disconnected from its 3-year average of 8.6, and the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 9% discount rate to account for the high yield and a long-term dividend growth rate of 5%. This dividend growth rate is right in line with the company's own 5-year dividend growth rate. As I pointed out earlier, I think this is a pretty reasonable expectation for where things should go. The payout ratio is moderate, they've proven capable of this kind of dividend growth, and their service area is experiencing a large influx of people. I don't think this is setting the bar too high. Indeed, their most recent dividend increase was 6%. The dividend discount model analysis gives me a fair value of $82.16. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Pinnacle West as a 4-star stock with a fair value estimate of $89. CFRA rates Pinnacle West as a 3-star hold with a 12-month target price of $85. I came out on the low end this time around. Averaging the 3 numbers out gives us a final valuation of $85.39, which would indicate the stock is possibly 20% undervalued. Here's the bottom line, guys. Pinnacle West Capital Corporation is a quality U.S. utility business that benefits from the immutable truth that is the need for electricity. It's been virtually unaffected by the pandemic, and it's operating in one of the fastest growing areas in the United States. With a market-smashing yield of almost 4.5%, solid dividend growth, a moderate payout ratio, and the potential that shares are 20% undervalued, this is a stock that all dividend growth investors should be looking at. Watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also, take a look at the description box below for some important links, including a link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is and am often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.